You're listening to DFW Real Estate Weekly, brought to you by the Patrick Glaros Mortgage Team, Republic Title, and the Todd Tramonte Home Selling Team. And now, live from the PatrickGlaros.com studio, your host, real estate broker, consultant, and best-selling author, Todd Tramonte.
All right, party people, lots to talk about today. We've got an almost full studio. We have got Full Price Courtney with us, shouting from the back.
She's here!
Ooh, right in the mic. And we've got the man, the myth, the legend. You've heard about him for years and years, Patrick Glaros in studio. Welcome, Patrick.
Thank you. Glad to be here.
You've heard us talk about Patrick for years. You've heard him on the show many times. But today we're diving into kind of what are all the mortgage-related factors in the market right now. I've read a lot lately about how the war in Iran is impacting banking and the Fed and Treasury and bonds and rates, and you're going to hopefully make sense of that for us because we do not claim to be mortgage pros. But before we do that, in my opinion, the world became overly obsessed with mortgage rates in the last 10 or 15 years. Before, during, and shortly after COVID, it was like the only real estate conversation anybody really was wanting to have is, can I get that rate? Can I refi for that rate? I'm stuck with this rate. Rate. So we are going to talk about mortgage rates, folks. So stay tuned. Hang with us all the way through the episode. But we're also going to talk about things that are not obsessively mortgage rate related. Because I think, and from past experience, I know that Patrick thinks, there's a heck of a lot more to getting mortgage right, purchasing a home, investing in real estate, keeping or selling a property, simply than mortgage rates. So that's out there. I've laid the groundwork that we're going to talk about mortgage rates. You're going to get your cheap fix, but then we're also going to talk about some things that the average buyer, borrower, investor, person that's just paying attention to the economy is often not looking at, and I think they're getting harmed by it. Is that a fair summary? Would you generally agree with what I'm saying, or should we start with a disagreement?
Nope, I think you're right on there.
Disagreements are more fun sometimes. But, all right, so we're on the same page there. All right, we do have a war. By the time people are listening to this, maybe we'll have an agreement to pause or stop the war. But there has been conflict between the United States and Israel and Iran and other neighboring countries. Does that impact mortgage rates here in Dallas-Fort Worth at all?
It does, and it has. We got to a point where interest rates were coming down and had fallen below 6% really for the first time in the last few years.
It's an exciting week.
Yeah, it was an exciting day because literally we hit our lowest rates on a Friday. The conflict started on that night or on Saturday, and by Monday, rates had started to make a run higher. And so, from a 3-month time horizon from when that conflict started, we saw mortgage rates run up about 0.75%, which is a big move in 3 months. But I always challenge people to zoom out a little bit. And, in my head, that's a chart. And so I'm zooming out on this chart to see a longer time horizon. And even though rates went up that fast, and it's all you could see on the news about mortgage, we met where rates were coming down from in August of last year.
Okay, but I appreciate your expertise here, Sir Patrick. But if I'm someone who's dying to buy a house, I really don't care about all that, right? Like I just care about what can I or can't I do. So from that perspective, your answer to the question is yes. The war in Iran, directly or indirectly, absolutely. The timing was too spot on to say otherwise. The war changed rates and they went up.
Correct.
Okay. Now, there's a couple other just tactical things I want to ask you, and then we'll back away and starting getting into some nuance for our friends in DFW that might want to make real estate decisions, because that's what we do here on DFW Real Estate Weekly with Todd Tramonte. I'm Todd, but I'm almost never alone. We've got our go-to mortgage expert, Patrick, with us. And we always have the voice of the people, Full Price Courtney.
Here she is.
Okay. the Fed chair, the Fed governors, Federal Reserve, Fed rates, lots going on there. There's rumors that, I think the dumbed down, not accurate, oversimplified version is, President Trump doesn't like the person choosing rates and he's chosen someone else. That's flawed, but as short as you can, what is happening there, and does it matter to us who are paying attention in the real estate and mortgage world?
There has been a changing of the guard. So Warsh will be the new Fed governor, and many people think that he might be more accommodating in the Fed policy. But the bottom line is a Fed governor and everybody that's part of the Fed has a dual mandate, and it's for employment and inflation. And so...
Now, to pause quickly, there's a difference in a Fed governor and the Fed chair. So what do you think's going to happen, old guy, new guy? What's your belief? Or what do you think the market is saying? Maybe not your belief.
I think the market is saying that as much as the president may want to lower interest rates, that they still have to look at the data to make their decision. Now, if Warsh is more inclined to make a decision to lower rates based on that data, I think that's a real possibility. However, there's still that dual mandate. And so employment has been strong, which doesn't give the Fed a big reason to go and cut rates. And inflation has been coming up a little bit. And that goes back to the conflict in Iran. Oil's gone up a bunch. And so other items that flow into inflation readings are impacting that. But as the conflict winds down, there are ships passing through the strait right now, and that may stop and then it may start again. But as that happens, it releases some of the pressure that's put on oil, that's put on interest rates. And so right now that pressure has just forced everything to rise. And so I think between the Fed changing over, much less with the maybe easing of some of the conflict, we will see that pressure release and see interest rates hopefully come down. Whether that means the Fed cuts their Fed funds rate is one thing. Which is different from mortgage rates. Now, they often move in similar directions, but the Fed is controlling short-term borrowing rates. It's how they bring money into the banking system, into the economy. And that's on short-term borrowing. It's what impacts our credit cards. It's what impacts our auto loans, our savings rates, but doesn't directly tie to our 30-year fixed mortgage that we're trying to make long-term decisions on.
Okay, excellent. Thank you very much. I know from my business, the real estate brokerage business, once again, oftentimes buyers don't care about any of that. Now, the reason on this show I'm bringing an expert like you on is because the people that watch and listen to this show are the ones that care and want to know why and want to know when and want to make excellent decisions. So for those people, just to recap, the war in Iran has been a factor. There is a new Fed chair. There was debate about whether Trump would get his guy, if the Fed governor would become the Fed chair, all that stuff. So Warsh is the new Fed chair, much younger, seemingly has a different perspective on economies and how things affect other things. So what I'm hearing you say is the war is a factor. So if the war comes to an end, that factor could go away or just change. New Fed chair, that's definitely a new element. Indications are that he's more likely to lower rates if external factors like wars and oil and banking and the economy go in the directions that they would like or people expect. I've heard you say for 20 years now, I think, that it's not this simple, but if you had to simplify it, there's kind of one primary metric you and folks in the mortgage world are looking at as far as rates and yields and bonds and things like that, that is more indicative of mortgage rates than necessarily the federal funds rate. What is that?
It's the trading of mortgage-backed securities typically is the main driver. And, they're very similar to a 10-year treasury maybe because they are a long-term investment for somebody that is going to pay them a fixed rate of return. That's the interest rate that we talk about.
So if I tried to simplify that, some companies sold 10,000 mortgages to maybe 10,000 different people buying a house and borrowing. And then they've said, we're going to bundle these up and kind of make them like a stock, like a security. And then you can invest in those. And you're saying the price people are willing to pay for those, and I'm oversimplifying it on purpose, these big bundles of mortgages that have now become like an investment stock kind of thing. I'm using obviously oversimplified language. But you're saying the market for those, what people, big institutions are willing to buy and sell those for, is one of the indicators that smart mortgage lenders and companies are really paying close attention to, that the average person probably doesn't even know where or how to track. Is that right?
That's correct.
And that, to you, is a better indicator of where mortgages are or where they will go than necessarily the federal funds rate, which the Federal Reserve and the chair of the Fed are setting or moving or not moving.
Definitely.
Okay. So I'm just trying to understand. Patrick knows way more than me, but we need to relay this information to the average person. Okay. So big picture about where are mortgage rates right now for a buyer in Dallas, Fort Worth, if they've just, let's just say they've got slightly better than average credit. Like they're a quote normal, whatever you would say is normal borrower. About what's the range of a mortgage rate today?
Probably somewhere in the mid sixes at the current level.
Okay, so 6.5% interest rate, which based on the last few years is decent. And that's what I would label it. What do you think?
I agree. I mean, but it's below the historical national average and lower than where we've been in the last couple of years. And so really, if you strip out this, it's likely an anomaly from those COVID years.
Right.
Rates are sitting at a good level.
Okay, so when you're talking about zooming out in your mind, you're zooming out on that graph to see a longer history of rates, and rates have been 18, 19% at times. They have almost never been in the 2s, 3s, and 4s like they just were for a little while. So we're all a little bit shell-shocked that they're up into the 6s and 7s lately, but 6.5 is about where we are today. Historically, that's a below average rate. And in recent history, that's an average-ish, slightly below average rate. Because we were sitting high 6s, low 7s for, the bulk of the last year or more? That's the way I remember it. Okay, so in your mind, when someone comes to you and says, hey, we want to buy a house, we're ready to get a mortgage, and they're just thinking, like, can I afford a house? Are people in the Dallas-Fort Worth area more optimistic, more pessimistic, more cautious? What do you think the tone on your side of the borrower, the typical borrower, is lately?
I think a lot of people are starting to realize the opportunity that we're in right now. And it usually takes the ability to look past that interest rate only conversation.
Amen.
And we're talking specifically about how this impacts mortgage rates, a major driver of affordability and what somebody's monthly payment is going to be. But maybe a more important driver of that is what's the opportunity with home prices and inventory, and the opportunity that creates for buyers. And so while I can't speak directly to that side of the equation, I have been saying for years that we will find ourselves in a perfect storm, and we won't know when we were in the perfect storm until we're out of it. But that perfect storm is probably going to look like something where interest rates have started to come down from their higher levels.
Check.
They're starting to normalize. Maybe we have now more sellers that have decided to step into the market and move into what might be that next phase or that forever home.
Last week's episode, check.
And rates have not come down so far that all the buyers have come out of the woodworks like we saw back in the COVID era.
Yeah, biggest warning we've been giving since then. Check.
And so, again, we won't know until we're out of it, but we've checked some boxes there, and I think we could be reaching one of those levels. And that doesn't mean that you were able to buy and get your lowest interest rate when you bought. That market is going to be fluid. I think the opportunity that is more permanent and has a little bit more stickiness to it is this environment that's available in DFW real estate.
Okay. So let me try to give the real estate side of that, because you're checking all my real estate boxes. But from the real estate side, we tell people, look, let me just ask you, when do you want to buy a house? When everybody's fighting over them, or when you can be more patient and have more choices? Well, in that scenario, everybody wants to be able to be more patient and have more choices. Okay, that's where we are today. Would you rather pay a little bit more in mortgage rate and a lot less total purchase price for the house, or a lot more for the purchase price for the house and a little bit less in mortgage rate? Now, people don't like to answer that question as much because we've talked about how obsessed they are with rate. But when they're careful and quiet and sober-minded, they'll say, well, I'd rather pay less price for the house and a little bit more for the mortgage. I could pay that off. I could refinance that later.
Is it 6 one way, half a dozen the other?
So I was just about to go to you, so I'm so glad you jumped in. Before we answer that, just which one has the bigger tug on your feelings, on your heart, on your motivation? We always use Courtney as the voice of reason. She's not licensed in real estate, not licensed in mortgage, but she's around it every day. So what?
I don't think that we have been taught that mortgage is a debt in your life. Like, to me, it feels like this. I'm just telling you where I'm coming from.
Yep.
And it's just this whole other juggernaut of money that I don't feel impacts my day to day. It's a loan I get approved for. So I care more about the rate.
Yeah.
I don't. We don't have enough conversations around it, or it's like kind of the same headspace around taking out loans for college. Like, these are just big chunks of, these aren't credit cards.
I think that people think like this is just what you have to do. It's just a factor.
Yeah.
But unfortunately, the thing that has been seared into people's minds is the rate is the deciding factor, not one of the deciding factors. And so what we're saying is, yeah, you may not be fired up about a 6.5 because there was a period you were looking at a 4. But what we're telling you is historically 6.5 is below average, and right now is an excellent time. The 6.5 I've said is it's like your defense. It's what's giving you less competition for the home, lower prices for the home, time to think about it, get a seller to credit something back to you, or give you some terms you might not have otherwise gotten. You may be wishing for a 5% mortgage rate. If we get to a 5% mortgage rate, the price goes up, the competition goes up, the negotiability from the seller goes down, and the terms are less in your favor. So you might pay $200 less per month, but it might have cost you $62,000 in home value and more liability and less repairs, more fears of deferred maintenance. That's not a win. But there's a lot of people that would say that's a win, and they over drinks with their friends would be like, oh yeah, we timed this. We waited and we ended up with a 5%. And that's just foolish math. Okay, so I think we've addressed that adequately. This show is brought to you by the Todd Tramonte home selling team, where we guarantee to sell your home over the average price and under the average time. We also guarantee to help you buy a home and save at least $5,000 throughout the purchase process. Check out over 800 5-star reviews on Google. We'll get back to the show. Patrick, from your side lately, what are some of the other factors that you see affecting affordability that either borrowers need to think about more, or maybe they're thinking about too much? I mean, obviously the ones to me that come to mind are taxes and insurance, but how much are people factoring that in when they're talking to you about borrowing for a home?
Taxes and insurance are definitely a factor, and I spend, maybe more time than I should trying to educate on that component because it is such a large line item of that overall mortgage payment. And just taking one step back about the interest rate, I think Courtney, to your point, and I think so many people out there, is what if I told you that when we look at interest rates, there's not just one interest rate available on a given day. We look at a rate sheet, and the rate sheet is going to show us interest rates that maybe go down to 5%, and then maybe they go up to 7.5%, depending on the day. All those rates are available. And so this opportunity, this defense that those interest rates naturally being at 6.5%, what that does is it creates flexibility in a seller that otherwise has not been there and will not be there when those rates come back down and everybody's fighting over the same house. And so one of the tools that we're using and that builders are using every day,
all day,
is they are buying down the interest rate for their clients. And so they are taking some of that flexibility that they have in the price and they are buying down that interest rate either permanently or using a temporary buy down. And so what that might look like is maybe your default rate's 6.5, but if you're working with the Tramonte team and they go to bat for you and negotiate off that asking price, they might be able to get a concession that allows you to buy that interest rate down permanently to 6% or 5.875, and also have a temporary buy down where in the first year you could buy that rate down to 3.875. It goes to 4.875 in the second year. And so I understand and agree that the interest rate is a key component. I think the missing link where people need to be educated is that there is never just one interest rate that's available. And so without that flexibility that we have in this market today, that's what creates that perfect storm. It doesn't mean you're going to take all that and use it to permanently buy down the rate. We can model that and determine if that's a good decision. But there are options available in this market that aren't available in all markets.
We're going to jump into a rapid fire here in a minute. I'm just going to pummel Patrick with all of the mortgage questions that we get all the time. One of them was definitely going to be like, do I have more than one option? So just to expound on what you're saying, we run into buyers all the time that are like, I got qualified for a mortgage, as if like it was a yes, no, red light, green light, instead of, well, I had quite a few options at quite a few rates, quite a few different amounts of cash I could or wouldn't need to bring to and that's why you do need an advisor, not like I went to the bank and I qualified, pass, fail, but I had someone walk me through the process and show me how many different options I really did have. What's the upside of getting that rate down to 3.85? What's the downside? Why would someone not go with the absolute lowest rate they could possibly get? Someone that's going to evaluate your timetable, your financial situation, your amount of your cash, the payment you could afford, how you're going to approach taxes and insurance, what type of insurance you may want or need for your home. Insurance has been one of the massive negative factors on home ownership in DFW lately because the cost of homeowners insurance, wind and hail policies and things like that have gone through the roof because we've had a bunch of hail and these companies aren't making money or they're not willing to price them the way they are. And so that has nothing to do with mortgage, has nothing to do with real estate, but it's going to impact everything we do. So there's a lot of different factors on affordability, but people just put so much emphasis and energy on rate. It is important. It's just not the only important factor. And if you have a great leader, guide, advocate, and Patrick's the only person I've ever used in well over 15 years, is you're going to see that you have more options than you ever thought. And you really are navigating a strategy in a game more than just taking what the market gives you. Okay. Real quick before we jump into some local mortgage rapid fire, what are some of the most common, most obvious mistakes that you see buyers or borrowers making lately in this market in DFW when it comes to buying or investing in real estate?
I think the biggest mistake is not understanding what options are available.
Yeah.
And so I think we all do our best to come in with a game plan or a strategy, and maybe we've got a team of advisors that we lean on to help do that, or maybe we don't. We're just trying to do it on our own. But we go into an experience like a home purchase, and maybe it's how much money we're going to put down, or maybe it's how much we feel like we need to save before we are able to buy a house.
Yeah.
I've always been told PMI is the worst. I don't want to have to pay PMI, so I'll be ready to buy a house when I can put 20% down. And that's great. That's a fantastic goal. However, if your credit's great and you're getting a conventional loan, that mortgage insurance can be a negligible amount, especially when we look at the totality of the overall payment with the property taxes and the insurance and the interest rate. And so even if you have the 20% down to put down, I like to ask somebody if they would consider more down, less down, and then how does that impact their monthly payment? What's the trade-off? There's always an opportunity cost. And sometimes when people can see what their payment is with 10% down, even if that includes PMI, versus what their payment is at 20% down, they said, wait, that's $40,000 of cash that after-tax dollars that I've saved, but it only moves my payment this much.
Right.
Yeah. Our kids are getting to the age that, like, I talk them through some of the decisions that Dana and I are making as around real estate or finance or investing or business or whatever. And it's fascinating for them. They're young enough that just makes perfect sense to them. Like, yeah, well, just look at all the options. Like, you can bring more cash, be out of pocket more cash, and get this little bitty difference in your payment. Or you could just go, okay, this is a little bit over here, a little bit over there. I'm going to let my payment be a little bit higher here, and I have this cash over here. We recently, with Patrick, tore down a house, built a new house, remodeled the house we were in the Gap and all this stuff. And there was a lot of those conversations with my oldest and eventually two oldest kiddos. And it was like, look, this is not the lowest mortgage rate we could get, but we're not going to have it for very long, so we don't care. This is either a lower rate because we can put more cash in, or we'll do the work, the remodel, the repair with cash and borrow less overall, and we'll benefit more there. So those were two times we didn't do the thing that by default most people would say you have to do, which is lowest rate, biggest down payment. We didn't do either one. Now, we were being very careful to steward our financial resources about as conservatively as somebody could. It just didn't look like the predictable, stereotypical deal. So that's just living examples of exactly what you're saying. Okay, let's do a little bit of rapid fire if you're willing. And my hope is that for the person that is thinking about buying, has recently bought, might want to buy a second property or a third property, there'll be some nuggets of gold in here. If I'm in Dallas, Fort Worth specifically, and I'm considering purchasing or purchasing real estate, let me just say this. Okay, for my personal residence, how early should I start talking to someone about a mortgage?
I think as soon as you have the idea that it might be something you want to consider, so that you can better understand what the options are, what the numbers are.
And what's the risk of waiting later?
I think the biggest risk is just finding out information that you wish you would have learned a lot earlier.
Okay.
To create the proper strategy and a timeline to
more
get what
urgency,
you want.
less options. Okay, so now if I'm investing in real estate, or if this is not going to be my personal residence, do I have the same options or different options as if I was buying my own home?
You really have more options, because one of the products that works for investors and that we do quite often is a debt service coverage ratio, or DSCR. And so that allows somebody to qualify based on the either current rent or projected rent that they're going to receive on the property. And that is the qualifying income that's used to be able to get the loan. So the rent
my tenant pays me helps me pay the debt I owe the bank. So I can basically borrow with the tenant factored in.
That's right. And even if there's not a tenant yet in there, the appraiser can do a market rent analysis, and we can use whatever that projected rent will be whenever they get into the market.
Okay, so more options for an investor. Okay, let's say I live in Dallas and I'm trying to decide, do I want to buy in Aledo or Plano? Are my mortgage options going to be different in different parts of town?
There are some parts of town that might have USDA as an option, but you're really going to be out in the outskirts. Most of DFW does not have USDA eligibility. There are some pockets, but otherwise it's all going to be pretty similar. The main difference is going to be things like your property taxes. And there's some really good tools and calculators out there that you can use. I've got one included on my site that allows you to go in, choose what county, choose what city, school district.
And where's that again?
At patrickglaros.com.
Love it. Okay, so basically the principal and interest, the mortgage rate and all that is not going to change whether I'm in Fort Worth or Dallas or Aledo or Richardson or Plano. But the taxes I have to pay to the school district, because the school districts are different, or the hospital district or whatever, that part might be different.
That's right.
Okay. How much are people having to put down as a down payment on mortgages right now?
There's options available for as little as 3% down with a conventional loan where somebody's a first-time buyer. FHA buyers are putting 3.5% down. And then I'd say the average buyer in Dallas is putting more like 10% down. And that includes people that have sold a home and are using some of that equity that they got out of that, mixed in with those first-time home buyers as well. But, probably somewhere in that 3 to 10% range is what we see pretty often.
Okay, so minimum 3%, and then you could almost go as high as you want and borrow whatever remains. I could put 90% down if I wanted, and you could give me a mortgage for just the 10% remainder.
That's right. And sometimes we'll back into it. Somebody says, you know what, I could see myself selling this house, moving into a new one, but I know I can't have my new payment be over this amount. And so we reverse engineer into it and find out, all right, what does the Tramonte team need to sell your house for in order for you to get enough out of it so that you can make your down payment and buy down your interest rate that we want? We've got a client right now that we've done that with, and we used part of those proceeds to buy down their interest rate to where they wanted their payment to be so that they could, see a clear picture and confident picture of the future.
Love it. Love it. So that answers the next question, which is, do I have to put 20% down on my mortgage?
You do not. Where that comes in is from that private mortgage insurance component, which can be avoided with 20% down. But I think before somebody makes a decision of, that being their requirement or their need to take this leap and purchase a new home, it's worthwhile having a conversation just to see how much that impacts their numbers.
Okay, next question. How do I shop for a mortgage?
Really, it's applying with a lender or multiple lenders and having them provide a detailed loan quote or estimate. If you have a property already, they can provide a loan estimate. Otherwise, just ask for a detailed quote. The challenge can sometimes be that they're all going to come in different formats. Somebody's going to send you a fees worksheet and somebody else is going to give you a loan estimate. And so, I help a lot of people navigate that. And sometimes it's reviewing what people have already received and just finding out if there's a better deal or telling them that, no, you've got a great deal. You should just go with this.
Okay, so what's the difference if I go shop that at my local retail bank where I use the ATM or I call someone like you? First of all, what is the difference? Like, what are you that is not? And then what's the difference in my experience or my options or my outcomes?
So when you go to your bank, they may offer mortgages, and it's going to be one of many financial products that the bank offers. And within that, they're usually going to be beholden to their own products and options, their own rates, their own products and offerings. We operate as a mortgage banker, and all that our company does is residential mortgages. And so we don't take deposits. We don't do car loans. We don't do business loans, SBA loans. We focus specifically on residential mortgages. We still close, underwrite, fund all of the loans within our ecosystem, so we get control over that process. But we're not beholden to one lender, one bank, and their products and pricing. So we can still go out and shop that, kind of like you would think about a broker, but we get that added benefit of not having to relinquish control over the important component of, contract to the actual closing of the loan.
Okay, so to compare, I have kind of like my local whatever, Bank of America, Chase, whatever. I can go in there and they do deposits and CDs and investing and all sorts of stuff. So they're going to have some, maybe they will. If they do, they're going to have some mortgage options, probably not any dedicated mortgage guru expert types, and probably a limited array of options. I can go to somebody like you who has the same general banking ability, but specializes in mortgage banking, controls the bulk of the process in-house, and can advocate for me as your client. Or I could go out like to a website, drop my information in there, and that's sort of a volume cattle call game. And in my perspective, I lose the advocacy piece, I lose the local knowledge piece, I lose the communication piece, but I may get some, I don't know, what the upside is, like some promotional offer or something like that. Some of the other options are I could go with the builder. They're doing some of this buy down stuff, but it feels out of my control because they want everything to be in-house, and that feels a little wonky to me. So there are other options, but you're saying if you want to compare, apply with multiple. If you're only going to apply with one, apply with someone that can shop a wide array of options for you, which is not likely to be your local bank. Okay. A couple more. What do most people fear that they don't need to fear about the mortgage process? Like what are some things that people come in with concerns that they are unnecessary or inaccurate?
I think the down payment part is definitely one of them. I think the other one is credit. Credit is a big driver in mortgage rates and what somebody's able to borrow and at what terms. And I think there's many times a hesitancy to have credit pulled because somebody's afraid that inquiry is gonna hurt their credit. And so a couple things. If you are out there shopping for loans, I would definitely have somebody pull your credit because you're not going to get a real accurate quote unless somebody has seen the full picture and been able to base that quote on a real and live credit report. And at the same time, you can go to multiple lenders and have that credit pulled and those be lumped together as one inquiry. So the credit bureaus look at that and say, okay, Courtney is not out probably looking to buy multiple houses with these mortgage inquiries. She's probably shopping for one mortgage.
Okay, so quickly, just to unpack that, people are afraid that if I have multiple people pull my credit, it's gonna hurt my credit score. It's gonna make it go down, and then I'm gonna get a worse deal. You're saying go ahead within a short period of time. If you're going to shop with multiple people, do that within a relatively short period of time. Let them do that. The credit rating agencies are going to see that, over a 2.5 week period, Courtney had her credit pulled 3 times, all from mortgage related entities. That's one pull. That shouldn't have a negative impact. If there's any impact, it's short lived. It's kind of singular. It's lumped in, and it shouldn't really change your ability to not get any certain terms. Is that a fair summary?
That's right. And then on the other side, even if the intent is not to go and shop mortgages, if it's I want to buy a house at some point in the future, the earlier that somebody like myself can review that credit report, the sooner that we can confirm or deny how good or not good that credit might be. But I so often see a credit report get pulled and there's a surprise on there. Oh, I don't even know what that is. I don't know how I addressed that. I paid that on time. That's not accurate. And I believe you. I do. But the credit bureaus have different data that's reported. And the sooner that we can identify that, the sooner that we can come up with a resolution and get that back to the credit bureaus and say, no, this was incorrect. Let's fix it. And then we can immediately update the score. And now we've got a lot fewer landmines that we might step into.
That hits multiple things that we've said. The sooner you talk to a mortgage lender, the better, because you're going to know your options and have more options. And what you're answering my next question was, if I have my credit pulled, is there anything I can do to change it? And you're saying yes. Number one, you can remove some inaccuracies. It takes a little time, though, so you want to start earlier. The other thing I would ask quickly, is there anything I can do to increase my credit score for the purposes of preparing for a mortgage?
Most definitely. So the biggest drivers of your credit score, of course, your payment history. That's going to count for 35% of your overall credit. Did I make the payment on time? Are there collections? Anything like that? The next biggest driver, I don't love it, but it is the use of revolving credit. And so that's 30% of your available credit score. So
Courtney, get ready to feel like this is the opposite of what should be true.
It is, but it's the game. And so we have to play the game. And if you don't play the revolving credit, which is a credit card that you would have with the bank, with a department store, your gas card, whatever, if you are not playing that game, you're missing out on 30% potentially of your available credit score. And so you have to play the game. That might mean having 2 or 3 revolving credit accounts on your credit that are open and active. Now, those don't have to be cards that you put all your bills on and that you pay everything on. Use it once, let it report to the bureaus, and then you can let it sit. Go freeze it in a block of ice.
But in short, what you're saying is the credit agencies want to see that you have a few revolving credit lines open that you're using and you're doing a good job with. Like you
Right.
use them and you pay them, and so we could trust that you would pay us.
That's right. And they want to see, part of the game is it's revolving credit, and so they give you a line, they give you a limit. And so they want to see how you handle the limit. And so if they give you $1,000 line on that card, if you keep a balance on it at $900 a month, well, they're going to look at that as 90% utilization. Your score will go down. Even if you pay it off every month, if it's reporting to the bureaus when it's at that $900, that's what they're going to evaluate your credit score on. So reviewing that and normalizing those credit card balances on any accounts that you do have open can make a big impact on your score just by playing the game so that you can hopefully get better loan terms.
So what I'm hearing you say is, yes, there's quite a few things you could do, and there's some really significant things that people don't often do that can kind of hurt their credit score, which could hurt their rate, could hurt their mortgage qualification, and things like that. Some of it is counterintuitive. Folks like Dave Ramsey and others are saying never use a credit card, which in principle I would personally agree with. But if you want favorable loan terms and you do want to borrow to own residential property, then you might want to play that game, and you might only want to play it for this reason. And you could still be careful and conservative and safe in doing so. Okay, so that's a bunch of things. Then my last question, and it's okay if your answer is no, is there anything I haven't asked you that people need to know about mortgages in DFW for residential real estate right now? What are people worried about, concerned about, needing to know that we have not asked you in this rapid fire round?
I think people need to hear that sometimes the market will send signals that scare us or instill fear that we need to wait to do something. And I think right now we're seeing that depending on, which day you turn on the news, but if rates are going up, guess what? They're going to tell you about how rates are going up, and they're going to make it sound like an opportunity has already been missed, but we are in the opportunity. Yeah. And I think the same thing for just home prices and everything else. I think folks are running to new construction because they can see an advertised rate that they want. And sometimes they're moving to an area that they might not have really wanted to be in. And I think there's so much opportunity in the DFW market with our existing inventory, where buyers have an opportunity to go in and kind of call their shot. And interest rate will be a part of it. But remember, you can buy down that interest rate. The interest rate part is not permanent, but what you can acquire that property for is.
Yeah, I would just say the purchase price is at least as important of a variable as mortgage rate. And I think it's a significantly more important variable. But that's that. Deal with that as you may. I agree with you that there's a lot of fear and anxiety in the market right now. We always teach our agents a confused mind says no. And there's a lot of confusion and uncertainty and anxiety out there right now. Final question. Courtney, feel free to jump in. We'll go around the horn here. Do you agree with me that in 2027, many people in DFW will regret if they didn't buy property in 2026?
I mean, I look back and I think people regret it every single year. So why wouldn't you regret it now? Get on the horn.
Disagree.
Okay.
Just kidding. I don't disagree.
I agree. I look at a lot of data, Case-Shiller Home Index, or just home appreciation, anything like that, and there is more often than not a cost of waiting to buy, and we just can't quantify it until we're into the future, and that's never fun. So,
but right now we see all the arrows and indicators saying you got a little bit more inventory, you can be a little bit more picky, you have sellers willing to do a little bit more for you. The one indicator that may not be where a lot of people want is they can't get a 4% interest rate, but even that one, the mortgage rate is below average. So you have more options, sellers willing to play a bit. You can sleep on a decision. You can get a few things repaired. You can get a fair mortgage rate. Prices haven't gone up much in a year or year and a half. Some areas maybe 2 years. And there are indications that they will begin to go up later this year or soon-ish, that mortgage rates might come down, which sounds good, but will drive a bunch of other things that are not good for buyers. And so there's a window of opportunity now. To Courtney's point, there's almost always a window of opportunity that buying now is better than buying later. It's not always, it's almost always. But all of the obvious indicators right now say that's highly likely to be true. If you believe one of the crazy doomsdayers or someone out there that's saying the entire economy is going to be cut in half, I would just say, if or when that comes, you won't feel comfortable buying a house then either, because everything would be in just total fear shambles. So don't wait for that. But also, the right time to buy, to borrow, to sell, to make any significant real estate move is when you, your family, and your finances are ready. And if you're ready to have a conversation, understanding that you should start that conversation as early as possible. The later you wait, the fewer options, the less flexibility you have. How can folks reach out to you, Patrick?
You can find me on my website at patrickglaros.com.
Or if they wanted to reach out by phone, do you want them to or no?
Welcome to call at 469-399-2411.
Awesome. PatrickGlaros.com. You know you can find us at ToddTramonteTeam.com. This has been a little bit longer conversation, but lots of details. So dig into this. If you have questions, holler at Patrick, holler at us. We'll talk to you on the next one.
Hey, thanks for listening. Make sure to subscribe, leave a review, and share it with someone who needs to hear this conversation. I want to give a special shout out to our sponsor, Patrick Glaros. And for everything else, visit ToddTramonteTeam.com.